All right, so far we should be able to know that what accounting is, who are the users of accounting information, and what different uses they have, what kind of concerns they have towards the accounting information, and how to analyze the impact of financial transactions on basic accounting equation. And as I told you, the product of this course and the product of all the recording and accounting is basically the annual reports for a company or a business organization. So these financial statements, these annual reports, they include four basic financial statements, and their names are income statement. The first statement is income statement. The second one is owner's equity statement. The third one is balance sheet, and the fourth one is cash flow statement. Now, depending upon the type of business organization and the kind of principles and rules used to prepare those financial statements, the names for these statements can have alternate names. For example, income statement is also called profit and loss account, and that in short is called P&L account. So sometimes we see that profit and loss statement or profit and loss account is also replaced in place of income statement, and sometimes it's called the statement of comprehensive income. Then we have owner's equity statement, which can be a statement of shareholders equity, right? Depending upon the business, or maybe partner's equity statement. And then we have balance sheet, which is also sometimes called a statement of financial position, right? So statement of financial position can also be a name given to balance sheet. So you will find alternative statement names. For example, in America, you will find most of the companies using balance sheet, whereas in Europe, most of the companies would be using financial position, statement of financial position. Again, in Pakistan, you will see a lot of companies, they will be using this name, statement of financial position, right? Then we have a statement of cash flows. Okay, so mostly this statement has only one name, and it is usually with the same name in all the different types of recording procedures. Now, why they have different names, and if they have different names, is there some different kind of preparing these statements? Well, there can be minute differences in preparing these statements, but overall the format is, kind of similar. Sometimes you will find a vertical format for balance sheet, and sometimes it's divided into two parts that are in front of each other. And again, statement of cash flow can be made in a direct method or an indirect method. We don't have to go into detail of these things right now, but we are going to get familiar with the components of these financial statements. And let me assure you here that no matter how you prepare them and what kind of format you use to prepare them, the component would be most of the time the same kind of components that you use in one way of preparation or the other way of preparation. Okay, so before that, we will test our knowledge about net income, because the very first statement that you require to make is income statement. And that is quite obvious that a business would be most interested in knowing that what is the financial performance of our business organization. Have we made any money or not? Are we in profit, or are we in loss? That should be the very first question towards knowing a business's health. So review question is that net income will result during a time period when what will happen. So net income will be there. Net income will be there when your revenues exceed expenses. So your revenues, they need to be more than your expenses. Only then you have net income. Okay. So what is income statement? As the name tells you, that income statement is a statement which shows the income of a business. So this statement shows the income of any business. Now, in regards to this particular course, there are two things that I want you to understand and follow. And the first thing is that whenever you are trying to prepare a financial statement, use the header. How are you going to use the header? in the very first line, you will use the name of the business. So Baron's Repair Shop is the name of the business. So you will always write the name of the business in the very first line. Then you will write down the name of the statement that you want to prepare. Income statement, balance sheet, cash flow statement, owner's equity statement, whatever statement you want to prepare, the second line would be the name of the statement. In the third line, you will write down the accounting period or a particular date. Now we will talk about this, that when we talk about income statement is prepared, it is prepared for a particular accounting period. So it is not prepared for a single day. It is prepared for an accounting period. That can be a week, that can be a month, a quarter, maybe 6 months or a year, right? So income statement include, first of all, revenues. You always write down revenues first, and then you categorize or classify different types of revenues under the heading of revenue. Here we have the heading of revenues, and then we have only one kind of revenue, and that kind is service revenue. So if we have multiple types of revenues, then we will have a sub column here where we gonna write the amount for each kind of revenue, and we would write down the total in front of that, just like we have written this amount. And as you can see, there is a line underneath this particular amount. Why? Because we have one heading, and whatever components are there for this heading, we have to total them, and the total will have a strike underneath. So we can understand that this total belongs to revenues. Okay, so similarly, we have a second heading, which is expenses. So we have revenues and expenses. Only these two items will show up on any income statement for any business organization. So in expenses, we have salaries expense, we have rent expense, advertising expense, and when we total them up, we have total expenses. So you can see that while totaling, we have an understrike for the subtotals, and then we have a understrike for totals. So the next step is to deduct your expenses from your revenues and to see that what is the result. Either it is positive or negative. If the result is positive, you have net income. If the result is negative, then you will have net loss. So here, since after deducting the expenses from revenues, we have a positive total. So this is what we call net income. So $3,200 is the net income for Baron's Repair Shop for the month ended May 31st, 2008. So for the month of May 31st, we have this much amount in our net income. Okay, so I hope you're well equipped with income statement. So this is the very first statement that we prepare. There's a reason for that, because we need this income to transfer to next statements. We will see where it connects. All the financial statements, they connect with each other. So as you can see that this $3,200 will be transferred to owner's equity statement, which is the second accounting statement. Now again, the same thing, I will repeat it once again, that first line, name of the business, the second line, name of the statement, and the third line, the accounting period for which you are preparing the financial statement. Again, since this is owner's equity statement, this is also prepared for a particular period. So we have a complete period here for the month ended May 31st. And then we start this statement of owner's equity with opening balance. We call this opening balance. Why we call this opening balance? There is a reason for that. If you see, this is being prepared for the month of May. So this period, accounting period, which belongs to 1 month, and it starts in 1st May. What was your capital on 1st May? We have nil capital. There was $0 on 1st May. Then what happened during this month? During this month, the owner invested how much? $10,000. And then we had income from the business operations, and that income was $3,200. And we added these two, and we got $13,200. Again, since we are adding two products, we have to understrike the last one. So we got 13,200. And we have to see that the owner has made any drawings, has taken any amount for his personal use or not. Since here the owner took $1,000 for his personal use, we will deduct this amount from the 13,200 capital of the business. So at 31st May, at the end of the accounting period, at the end of this month, you will see the total that we have in our owner's equity account would be 12,200. And since this is the net amount of this statement, this is the last amount, we will double strike it underneath. Okay, so here is a note for you that net income is needed to determine the ending balance in owner's equity. As I told you, all these financial statements are connected with each other. So owner's equity statement, which shows us the effect of different investments, revenues, and drawings, and that shows us the final balance of owner's equity at the end of an accounting period. That relates to the third financial statement, which is balance sheet. Now, look carefully that the first line is the name of the business, as we told you earlier, and the second line is the statement's name. But the third line is a little different from other statements. For example, in the owner's equity statement, we wrote down for the month ended May 31st, for the month ended. But here balance sheet is made only on one particular date. So balance sheet is also called snapshot of a business. Why this is called a snapshot of the business? There is a reason for that, because this is only made for one day or one particular time. And there is a reason for that, because these things change very frequently, your assets, liabilities, and owner's equity. And since they show the worth of the business, and we have to look at the worth of the business on a particular time, right? And when the time changes, the worth also changes. So when we move from one point in time to the other point in time, we will see the change in the balance sheet, how the things changed in the balance sheet. So we have to prepare the balance sheet on a single date. Now, after looking at the header, we will see what are the components of the balance sheet. Balance sheet will always have three components: assets, liabilities, and owner's equity. And assets are always written with liquidity. Most liquid assets would come first, and least liquid assets would come further. So I'm talking about GAAP here. Since we are following US GAAP and we are studying a book based on US GAAP, this is the way you do while following GAAP principles. But if you follow IFRS, that gives you a little bit of flexibility. You can write them in reverse order. And there are other formats also, but we're gonna follow GAAP. So we will always write the first asset as cash, because cash is the most liquid asset. What is the most liquid asset? Liquid means that how easily you can sell out an asset and convert it into money without losing the market value, without losing the fair value. So cash, you don't have to convert it into money. It is already money. So it is the most liquid asset. Then account receivables, since you receive them frequently, they get converted into money. Equipment is the least liquid asset here in this list. So we are writing it at the very end because it is the most difficult to convert in money. It's very difficult to take your equipment in the market and sell it as compared to other assets. Okay, so first of all, we are listing down all the assets, and then we are calculating the total for them. So adding these three assets, we have a total of assets of $12,450. Then now this is one section of the balance sheet. You see that double strike. That double strike shows that this is the first section ending at this place. In the second section, we have liabilities and owner's equity. Sometimes the heading is written together, liabilities and owner's equity. So first you see liabilities. Again, current liabilities would come first and long-term liabilities would come afterwards subsequently. So first we see that accounts payable is a liability of 250, and then we have balance capital. So why this amount is red? Because this amount came from the previous statement that we made in the previous slide, and the amount was there. The amount was 12,200. Again, you can see the amount of equity is 12,200. Now, when you When you total second section of the balance sheet, which is liabilities and owner's equity, you find a very nice, symmetrical thing happening here, and that is both both parts of the balance sheet will tally with each other. 12,450 and 12,450. So if you remember, we had an accounting equation. What was the accounting equation? That assets should always be equal to liabilities plus owner's equity. So look at the balance sheet. The total for your total assets is equal to your liabilities and owner's equity. So this is the balance sheet. Now we look at the last statement, which is the statement of cash flow. Right, again, we have the business name, we have the statement name, and we have the header. Only balance sheet is prepared for one single point in time. Every other statement is made for a particular period, which is called the accounting period. Here, since this business use a month for the accounting period, so it is being prepared for the month. So in cash flow, we have three types of activities, and we're gonna go in detail in chapter number 7 for this, and we will see what are these three different activities, how they differentiate from each other. But I will give you a brief differentiation here. Operating activities are the activities that the businesses get involved in day-to-day basis. They are the short-term activities in a business. They usually get completed within a year. And then you have long-term activities, and they belong to the investing and financing. Investing is mostly involved with the long-term assets, those assets which have an age of more than 1 year. And financing activities are activities which help you to look at the liabilities and the owner's equity. And since a business is run by the financing, the funds which are financed by the owner or the creditors, the activities related to those two, they come underneath financing activities. And we're going to go into details of these in chapter number 7. So first of all, we have cash receipts from revenues, then the cash that we pay to expenses. These are day-to-day operations that businesses encounter. So you can see the difference between these two is $2,820. And this is cash provided by operations. So if this amount is negative, we will say cash used by operations. But since this is positive, we will say cash provided by operations. Okay, then we have investment activities. In investing activities, we purchased equipment worth of $5,000. So we have a parenthesis around this amount, and these parentheses show that this is a negative amount. And then we have cash flow from financing activities. So investment by the owner was 10,000, then the drawing by the owner were 1,000, and then we had $9,000 net amount in the financing. So then what we're gonna do, we're gonna add up these three totals, $2,820, 5,000 and 9,000, and the net amount would be 6,820 because we have a negative amount here. Right, so this is the amount in cash that is remaining with the business, and that can also be tallied and confirmed in the balance sheet. You can see that this information is there in the balance sheet. So first of all, we calculated net income from the income statement, and that income statement balance went into owner's equity statement, and that owner's equity went into balance sheet, and the balance sheet cash amount were tallied with the cash flow statement. So this is how four statements are linked to each other. Okay, so now we have a review question. Which of the following financial statement is prepared as of a specific date? As I told you, it is balance sheet. Only balance sheet gets prepared on a specific date. Rest of them, they get prepared for a period of time. Okay, thank you very much. So this was the end of the chapter number 1. Now I'll see you in chapter number 2.